So we're going to be talking then about a balance sheet. The balance sheet as of, and then you put a date, let's say 12/31/2022, for example. This is a picture, and so we use the words as of. If you were in England or other parts of the world, you use the words as at. They all mean the same thing. It's just a picture. We don't say balance sheet for the period ending. We don't say that because the balance sheet is not a movie, it's a picture. Okay? So it is going to list your assets, your liabilities, and your equity at any point in time. So you take a picture as of now, what do you have? Assets. The assets can be broken down into current assets, and the current assets are cash and cash equivalents. Okay? You can also have short-term investments. And you may also have accounts receivable. Accounts receivable. And you may have inventory and prepaid asset. So these are examples of current assets. Cash and cash equivalents like CDs and stuff like that that you can get cash for within 90 days, right? Those are cash and cash equivalents. So let's say that our cash and cash equivalent is, I don't know, let's say it's $1,000, for example. Our short-term investments is $2,000 as an example. Accounts receivable is, let's say, $3,000 as an example. Inventory is $4,000. And prepaid asset is only $500, let's say. So our total current assets is what? You know it's going to be 500 at the end, and then we need to be able to add 1 plus 2 is 3, 3 plus 3 is what? 6, 6 plus 4 is 10, so it's 10,500 in total current assets. As you could see, the most liquid asset came first, and the least liquid asset went last. We call this the order of liquidity. The order of liquidity means you put the more liquid asset first and you put the least liquid asset last. Does that make sense? That is the order of liquidity. If you were doing this under IFRS, you flip it. They call it the order of permanency. They like to put the buildings and the intangibles and those things first. But in the US, in other parts of the world, we like the order of liquidity as compared to the order of permanency. It's the same thing. It's just different perspectives of looking at the same information. You may also have what we call fixed assets. And then under fixed assets, I want you to become familiar with the acronym PP&E, property, plants, and equipment. That is PP&E. We can say net. Net of what? Net of depreciation. PP&E. Let's say that our PP&E is 4,500, for example. Okay? And then you may have certain intangible assets. Intangible assets. What would be examples of intangible assets? Copyrights, customer lists, and things like that. You can't see, but they have value. Those are examples of intangible assets. And let's say that is 1,500. So your total fixed assets is going to be what? $6,000, right? So that's your total fixed assets. Does that make sense? All right, guys? All right, so then if I add my 6,000 of total fixed assets, I add that to the 10,600, I get total assets of what? How much is my total assets? That will be 16,500, correct? 6,000 plus 10,500 will give me 16,500. That's my total assets. Does that make sense? Total assets. Total assets. Now, the accounting equation is saying that my assets must equal my liabilities plus my equity. So now, if I go to my, just on this side, just because I don't have enough space, I'm going to do the liabilities and equity here. So this is the side of the liabilities and equity. Liabilities plus equity. Asset equals liabilities plus equity. That's the accounting equation, right? We learned that. So what are my current liabilities? And then my non-current liabilities. So that's my current liabilities and then non-current liabilities. So examples of current liabilities will go out. Accounts payable, also called AP, if you like. Let's say it's 1,000. And then short-term debt. That is debt that you have to pay within 12 months or less. It's short-term debt, like short-term loan. And then you have accrued expenses. So let's say this is 500 and this is 500. So my total current liabilities is 2,000. Does that make sense? This is as an example, right? Total current liabilities is 2,000. The non-current liabilities are long-term liabilities. Long-term debt. Let's say that's the only non-current liabilities that I have is 1,000. So my total liabilities is 3,000. My total liabilities is 3,000. Another long-term liability that we could have written here is deferred revenue or unearned revenue to the extent that it is longer than 12 months to collect. Okay? So the rule here is if you are 12 months or less, you are current. If you are more than 12 months, you are non-current. Does that make sense? Right. So if my assets are 16,500 and my liabilities are 3,000, then my equity has to be what? 13,500 is my equity. How do I know that? It's basically my asset of 16,500 that we had there, right? Minus 3,000, right? 3,000, 16,500 minus 3,000 is going to give me 13,500. That's my equity. Now, if you want to know what is the makeup, what made up the 13,500, you will have things like what? Just in the interest of space, I will explain the equity here so you can understand it, okay? Just in the interest of space. So the equity, also called shareholders' equity, okay? Shareholders' equity, also called capital, is typically made up of things like common stock. It could be preferred stock. And then we have APIC, additional paid-in capital, also called excess over par. Over par. This is par. That means that's the legal or stipulated amount. Let's say that it is 2,000, and let's say this is 1,000. And excess over par, additional paid-in capital, which we're going to spend a whole lecture on. I'm not going to expand on that right now. Is let's say 8,000. Okay, and then you may have something that we call retained earnings or undistributed profits. Retained earnings, undistributed profits, or accumulated profits. Okay, I want my total to be 13,500 to explain the equity, and so now I have what? I have 11 here. So 11, if I want 13,500, what am I going to put here? I'll put 2,000 here. 11, I'll put 2,500. Because 11 plus 2,500 will give me what? 13,500, correct? So that's how I explain my equity. So these are just general ideas that I want you to be aware of when it comes to the balance sheet. Any questions on the balance sheet?